Selling a business, it's a huge moment. It's often the culmination of years, maybe decades of hard work. But right after you pop the champagne, reality hits, the tax bill. And the big question is, do you really have to pay it all at once? Well, the answer, more often than you think, is no. In this explainer, we're going to break down how you can strategically defer those taxes by taking shares instead of cash, and in doing so, turn a simple sale into a really powerful investment move.
Just so you know, this explainer was prepared by Samir Al-Rashani, PhD with AI support. All right, here's what we're going to cover. First, we'll get into the fundamental choice, a taxable versus a tax-deferred sale. Then, we'll dive into a classic scenario with a buyer and a seller to see how this all works in the real world. We'll look at the two main ways to do this, the asset sale and the share sale. And finally, we'll touch on a few other advanced strategies you might encounter.
You know, when you really get down to it, this entire decision, with all its complexity, boils down to one single question. Do you want the cold, hard cash in your pocket today, which, by the way, triggers an immediate tax bill? Or are you willing to take shares in the buyer's company to kick that tax can down the road and just maybe grow your wealth even more?
So, what's the difference? It really all hinges on how you get paid. In a standard taxable sale, you get cash or maybe debt instruments, which are basically just IOUs. And boom, you owe tax for that year. Simple. But in a tax-deferred sale, you agree to accept shares in the company that's buying you out. This is the magic key. It means you don't pay a dime of tax until you actually sell those shares, which could be years or even decades down the line.
Now, you are probably thinking, why on earth would I take risky shares instead of guaranteed cash? And that's a fair question. But there are some really compelling reasons. First, you might truly believe in the vision of the new combined company and want to be a part of its future success. Second, and this is a big one, by deferring the tax, you get to invest the entire pre-tax sale price. You're earning returns on a much larger pile of money from day one. And sometimes, it's just practical. The buyer might not have enough cash to get the deal done any other way.
Okay, theory is great, but let's make this real. It's time to roll up our sleeves and walk through a classic bread-and-butter scenario. This way, we can see exactly how these different sales structures play out, not just for the seller, but for the buyer too. So let's meet the players on our board. We've got shareholder Y, who owns 100% of a company we'll call Seller Corporation. And on the other side, we have shareholder X, who owns Buyer Corporation. The objective is straightforward. Buyer Corp wants to buy the business that Seller Corp owns. This diagram here, this is our starting point. It's nice and clean. Two separate companies, each with its own owner. You see shareholder Y connected to Seller Corp on the right and shareholder X with Buyer Corp on the left. Now, what I want you to really focus on are the numbers attached to the seller's side, because they are absolutely key to understanding everything that comes next. Let's start with the big number, the sticker price. The fair market value of shareholder Y's shares is $500,000. If this was just a simple cash deal, that's the number everyone would be talking about. But from a tax perspective, the headline price is really only half the story. Here's where it gets interesting, the cost base. Shareholder Y originally put in $100,000 to get this business going. Now remember, you don't pay tax on the sale price, you pay tax on the gain. So you take that $500,000 sale price, subtract the $100,000 cost, and you're left with a $400,000 capital gain. That's the number that shareholder Y wants to avoid paying tax on right now. But wait, there's another layer to this onion. The actual assets inside the corporation, the machinery, the inventory, the patents, all that stuff, they're actually worth $700,000. See how that's different from the share value? This number becomes incredibly important if we decide to structure the deal as an asset sale instead of a share sale. And just like the shares had a cost base, these assets have their own tax cost, which is $400,000. What does this mean? It means if the corporation itself sells off all its assets, it's staring at a potential taxable gain of $300,000. It is so important to keep this straight. There are two potential tax events here. There's the personal gain for the shareholder, and there's the corporate gain for the company. The way you structure the sale is what determines which one of those gets triggered. Okay, let's look at our first method, the asset sale. In this approach, it's the corporation, Seller Corp, that's doing the selling. It's not shareholder Y selling their ownership stake. It's the company literally selling the pieces of the business it owns. So, here's how the mechanics work. Seller Corp sells all its assets for their full $700,000 value. But to get that tax deferral, the payment gets split. Seller Corp can take cash and debt up to the amount of the asset's tax cost. That's the $400,000 we just talked about.
The rest of it, the $300,000 that represents the gain, is paid in the form of shares in Buyer Corp. That specific structure is what allows Seller Corp to dodge paying tax on the gain immediately.
This whole setup creates a really clear trade-off. For the seller, the big win is deferring tax, but the price they pay is taking on the risk of holding another company's stock. For the buyer, the advantage is obvious. They need less cash to close the deal. The downside for them, though, is that they acquire the assets at the seller's lower cost base of $400,000. And what that means is they'll get smaller tax write-offs or depreciation deductions in the years to come.
All right, let's move on to the second main approach, the share sale. A lot of people see this as a much cleaner, simpler transaction. Instead of the company selling all its bits and pieces, the owner, shareholder Y, sells their shares directly to the buyer, the whole shebang.
Look at how the structure changes here. It's a big shift. Shareholder Y sells their shares worth $500,000 directly to Buyer Corp. To defer the gain, Y gets cash equal to their cost base, that's $100,000, and takes the remaining $400,000 in the form of shares in Buyer Corp. Now look what's happened. Seller Corp is now a wholly owned subsidiary of Buyer Corp, and our old owner, shareholder Y, is now an investor in the parent company.
Now, let's put these two side by side because this is where it gets really telling. The most fascinating thing here is the difference in risk for the seller. In that asset sale, only about 43% of the payment was in shares. But in our share sale example, a whopping 80% of the payment is in shares. The structure of the deal fundamentally changes how much skin the seller has to keep in the game to get that tax deferral.
You should also know about a simpler version called a share-for-share exchange. It's pretty much what it sounds like. The payment is 100% shares. This can be great for sellers because they can just choose to defer their gain. But it's often a tough sell for buyers of private companies because they end up acquiring the shares at a very low tax cost, which can set them up for a massive tax headache in the future.
Now, beyond these two main roads, there are other, more complex paths you can take, like amalgamations and reorganizations. These tend to blend elements from both asset and share sales to get very specific results.
An amalgamation, well, it's basically a merger. Buyer Corp and Seller Corp legally dissolve and combine into one brand new single company. As the diagram shows, shareholder Y goes from owning 100% of a small company to owning 20% of a much larger $2.5 million entity. These are often structured as a takeover, and the tax deferral for the seller just happens automatically as part of the process.
A share reorganization is a bit different, and frankly, it can be pretty risky for the seller. Here's what happens. Shareholder Y exchanges their regular common shares for fixed-value preferred shares inside their own company. Then the buyer comes in, injects a little bit of cash for brand new common shares, and takes control. The big risk for Y is that their ability to ever get their money out depends entirely on the buyer's success at running the business they just sold.
So let's bring this all home. This slide really sums up the core trade-off, the fundamental push and pull of these deals. The seller gets that amazing benefit of deferring their tax bill, but they do it by taking on the risk of holding shares instead of guaranteed cash. And the buyer? They get to use less of their own money to do the deal, but they have to accept a lower tax cost on whatever they bought, which means a bigger tax bill for them down the road. It's a strategic dance, balancing risk, cash flow, and taxes on both sides of the table.
And all of this leaves us with a fundamental question, one that every single business owner has to answer for themselves. This isn't just a technical tax decision, it's deeply personal and financial. So when it's your turn, what's more valuable to you? The absolute security of cash in the bank today, or the tantalizing potential for even greater returns tomorrow?